Monday, May 13th, 2019, Maneco 64, home of alternative economics and contrarian views. So the markets are starting the week in a negative fashion. The Dow is down over 200 points right now. And yes, I'll look at what the markets are doing in a minute. Before that, I like to say that all the blame has been put on the trade negotiations. The fact that there is no deal between the US and China. The fact that President Trump has raised tariffs. Yeah, and that seems like how can I say, the obvious reason why the markets are looking quite toppy. I did a video on Saturday about this, and but personally I think this is more to do with cycles, credit cycle, than anything else. Of course, they're going to try to find a scapegoat for this. But the problem really is, in the end of the day, the accentuated, exaggerated boom and bust cycles that the central banks create, especially the Federal Reserve. And that's what I will look at today after I look at the markets. I'll show you an interesting chart of the Fed funds rate and the cycles, recessions and crises. So it's fairly early, 7:08 a.m. London time. Right now we've got spot gold. I would have thought gold would be higher today with the stock market where it is, but it's not. It's down $2 at $12.84. The range has been $12.88.70 to $12.82.80. Just quickly look here at the weekly chart at this falling wedge. We are actually getting closer and closer to the top of this wedge. It's lower now than it was last week, of course, because it's a descending line. This week it will be around 1290, 1291. If we can break through that, it could be quite positive for gold. So let's keep an eye on that and let's be patient. Gold, more than anything, is tangible insurance outside the system. A silver down 10 at 1469. I'm holding on to my silver as well. Nothing changes there for me. Range has been 1484 to 1467. Right now the Dow future is at 25,707, down 241. The low has been 25,681. So let's quickly look at the chart here of the Dow. You can see I was speaking about that spinning top on Saturday. If you haven't seen that video, go back and watch my video from Saturday. Technically, we need to break the low from last week, which was around 25,000, let's see, 450, 460 or thereabouts. We're still quite far away from that level. Until that happens, we could see the market rebound when the regular hour trading resumes later on today in New York. Who knows? But it's not looking great. Looking at that chart there, one of the viewers noted that if I thought a triple top was forming, since the beginning of last year, definitely it looks like a triple top right now. And it's a massive triple top being formed over like 18 months. Let's have a look at the S&P now. S&P is down also just under 1%, or down 27 points, 28.54. The low has been 28.50.84. Look at the chart here. Same thing here. The low last week was around 28.25. So that will be the key level. If we break through there this week, it will kick off even more selling, in my opinion. This is a weekly chart, of course. Today, it could even do it today, but right now we're already down quite a bit. Nasdaq 100 is down 85 or 1.1% at 7,502. Quickly look at a chart of the Nasdaq. That as well. I guess the low last week was 74.23. So we were much closer to key levels there. in the Nasdaq 100. Currencies fairly steady at this time of the day. The pound is up 0.1%, 130.13. The euro is unchanged against the dollar, 112.32. Dollar's down 0.25% against the Japanese yen at 109.70. And the dollar is up 0.2% against the Chinese yuan at 688.75. Yeah, the dollar's risen quite a bit against the yuan. Not surprising with the tariffs that have been reimposed and increased on the Chinese. Crude oil is doing fairly well. It's not down. And usually we see it get hammered on days like this when the stock market is weak. Brent crude is up 0.4% at 70.56. WTI is up 0.1 at 61.83. The bond market is looking interesting. The 10-year yield is down to 243. 243 and a half, 2.435% yield. The 6-month right now is at 2.431, so almost inverting between the 6-month and the 10-year. The 3-month to the 7-year is inverted by almost 10 basis points, so that's not a great sign for what the market is thinking of the economy going forward. So yeah, I mean, it's very easy to blame these, the trade dispute for the market going down. You see some of the headlines here on Zero Hedge, but I think it's more to that. This is just going to be used as an excuse, I think, for if the market does come off quite a bit, if we see a major collapse. So what do I think is really behind this? Well, I think it's just time. It's cycles. The market had been going up since 2009. Bottom, I think, was around March or April that year. I think the Dow got down to 6,600 or 700 or thereabouts, and almost above 27,000 in the next almost 10 years. And if you look here at the Fed funds target rate set by the Fed, ever since the last recession, 08-09 there, the recession is that gray line. They kept rates at zero for virtually until like 2016. Even though they had risen it at the end of 2015, but you can see that those rates were kept. I think you have to go back to like the 1950s to see Fed funds rate near zero, but that seemed to be very quick. That didn't stay there for long. Most of the time, it's been trading above the CPI, as you can see there. But we've traded for the last 10 years. Money has been free in real terms. And that's if you believe this CPI that they publish, which seems to be always around 2% or just a little bit under 2%. If you think that prices are rising by less than 2%, you're not living in the real world. So what I'm trying to say here, they've created a huge credit bubble. Yes, it hasn't flown into consumer goods, but it's flown into financial assets. And they try to, you can see here, they've tried to raise that Fed funds rate, but they got to a point right now where we saw late last year that doing that was going to bring the whole thing down. They had to backtrack the Fed and say that they're not going to raise rates anymore. They're going to stop unwinding their balance sheet in September. So they can't do it. But I think it's too late. The damage has already been done. And even though, we're at still really low rates as per the Fed funds, around 2.5%, I think they've broken the cycle. And we're going to see a big recession here. Why do I say that? Well, because the top of the Fed's rate rising cycles coincide with some kind of accident, as you can see in all the gray lines here, which are recessions. They tend to coincide with the top in Fed funds rate. And the last one you saw there, 2006 and 7, they started raising rates, and then they stopped, and then you had the 07, 08, 09 crisis. So when this is going to start, it could be the beginning right now, who knows, or it might have started already. It's always difficult to tell whether we're in a recession or not. When we are, it's usually looking back. Personally, I don't think we've been out of a recession in real terms, mainly because governments have increased debt so much since 08. Not only Obama administration, but also the Bush administration put the country into that debt cycle of higher debt, higher budget deficits annually, and Trump hasn't changed anything. So yeah, this is getting very interesting, and I think there's a point now, it's too late, and the Fed, of course, probably needs to wait until things unwind, and then probably they'll do what they know best what to do: print money, lower rates, more QE. Will it work? I'm not too convinced. I'm not too convinced it will work this time, because of what we saw, in the since 08, 09, how much funny money they've created. And by funny money, I mean, keeping rates well below, the CPI there for over a decade. I mean, that was never done before. Only, during bad recessions, but then it would quickly, you can see there that quickly the Fed funds rate would be comfortably above the CPI to maintain a sound, fairly sound and non-accommodative monetary policy. So that's what it's all about, in my opinion. It's getting very interesting. As I've said before many times doing these videos early in the morning in London, it's still very early in New York. It's especially early also in the West Coast. We need to wait and see what happens when the US comes in a bit later on. Things could change, but not looking great right now. Yeah, all of the headlines, mainstream media will be about the trade negotiations, the stock market. I wouldn't buy into it, even though I guess sometimes I look at the headlines as well. I think it's much more to do with the credit cycle. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. Make sure you share this video far and wide if you think other people would enjoy the content. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.